Hello and welcome to the i3 Podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. Welcome to the i3 Podcast. I'm here today with Michael Recce, who is Managing Director and Chief Data Scientist for Neuberger Berman. Michael, welcome.
Great to be here.
So I was talking to a friend of mine who is a data consultant, and he asked me, I look after data, I look at how to protect it, but I'm not a data scientist and I have no idea what a data scientist is. So Michael, what is a data scientist?
Yeah, it's a data scientist is someone who can creatively find insight out of data. And so data is, as Andrew Ng from Stanford, is the new oil. And there's so much information, and it's just a matter of actually thinking creatively about how to extract the information from data.
So how did you get into this field? Because I think you were an academic for many years before. You've done degrees in other disciplines as well. How did you come to data science?
Well, interestingly, actually, my first job was in data. So I did undergraduate work in math and physics. And in fact, as a summer intern, I got a job at Intel and eventually went to work for Intel after doing some graduate work in physics. And my job was actually analyzing data on the production process for making microprocessors, which characteristics, what the region of the production parameters where things would work. And so it's called a product engineer. And so I guess from my entire career, I've been analyzing data to try to find how to make things work.
And I think you also studied neuroscience. How does that help you understand artificial intelligence and that kind of thing?
Yeah, so what happened was after a few years at Intel, so I came from a working class background and I wanted to prove I could earn a living. And I could certainly prove I could earn a living. They were paying me too much. Didn't want my boss's job. I wanted to work in artificial intelligence. I knew enough computer science and engineering, but I didn't know any biology. So I thought if I want to work on reverse engineering the brain, I should learn some biology. So I did a PhD in neuroscience.
And have you been able to reverse engineer the brain?
Actually, yeah, it was fantastic. In fact, I was very, very lucky because my advisor in neuroscience was a guy named John O'Keefe, and he had some phenomenal ideas about how the brain worked, and I worked with him on it, helped him build some engineering to answer the questions, and he won the Nobel Prize in Medicine in 2014. Projected my image on the wall in Stockholm, which is as close as I ever get.
Fair enough. It's further than I get. So how did you then get involved into the investment field in the asset management industry?
Yeah, so I've been. What I liked about being an academic was the freedom to think about big open problems, but I missed the impact of being in industry. At Intel, if you had a new idea, 1 million copies could go out of the factory the next month. So I helped my students start a couple of startup companies. The first one was analyzing bank data in order to find money laundering and white-collar crime. We had 18 of the top 25 banks when we sold that business to Warburg Pincus in 2005. Then I helped another student start a business analyzing online activity to decide what ad to show people in real time. And I was running engineering at that firm in 2014 when I was recruited into finance. And interestingly, those problems are very, very relevant to finance. Because if you know what ad to show someone and online advertising has become almost uncanny in its accuracy. If you know what ad to show someone, you know what product they're interested in. And if you know that across all products and services, you know which companies are winning in the marketplace. And that's not priced into stocks. So it became very clear that knowledge of what people wanted to buy was actually going to be much more useful in finance than even it was in advertising.
Now, when you see today, there seems to be a lot of demand for data scientists. And it seems that every institutional investor at least is trying to do something in this space. Do you get an idea that is warranted, or do you think there is too high expectations around what you can achieve with data science?
Well, I actually think it's absolutely warranted, and I think that the expectations of what will be achieved with data science are still not quite at the level that's what will be achieved. I believe the data science-driven investing will be bigger than the quant revolution was. But on the other hand, I also believe that there's a great story around what Gartner calls the hype cycle. And we're in the first peak of the hype cycle, which is sort of a place where you have more heat than light. So I think many people and their enthusiasm to get into data science aren't going to do it the right way. And they're going to end up spending lots of money, becoming disillusioned, and almost miss the second peak of where real success happens.
Yeah, on that last point, this is why I asked the question, is it being overhyped? Because I've seen some organizations that really embrace the idea, but then they identified certain sources of data or data sets that they thought might be interesting for the organization, build the infrastructure, got a data set in, and then they were, now what we do? They actually didn't find a way to extract value or a benefit out of it.
Yeah, it's I guess it's called in computer science a bootstrapping problem, is you don't know what you don't know, and it's very hard for firms to actually figure out how to get started. They very clearly understand that they might miss something if they don't get started, but it's going to be quite easy for them to make wrong turns and to get burned and spend too much money doing the wrong thing. I'll tell you that most of the data that people want to sell is not useful. About 5% of the data that, from vendors that you could buy is actually useful. And so, a 1 in 20 shot is a pretty high risk if you don't know what you're doing.
Yeah, and I think the additional problem as well is that a lot of new data sets that are coming out of startups. And so you don't know if they're going to be around in a couple of years' time. How do you manage the integrity of sourcing the data? Yeah,
I mean, the other related problem in that space is that they want to provide a value add. I mean, some of these vendors, the data isn't theirs, and they want sort of a broker fee for a finder's fee. But and that's almost okay. But the ones who want to do their own data science to add value to it, there's a really big risk that they've muddled it in the process of actually trying to add value. But, the point you raise is also true, that some of those businesses might not survive themselves. And if you want access to the data, like anything, it's practice, right? So it's just a matter of actually getting closer to that and starting with some degree of expertise in the process. Part of what we found is that you just have to learn to ask the right questions, like anything else in any other vendor you're trying to work with. One of the questions which I find most useful with data vendors is asking where ground truth comes from. So if they're trying to tell you something, how do they normalize it? How do they actually compare it to some source of ground truth so that you can tell if it works? The other thing I try to do with data vendors is to put the onus on them to prove its utility. And I think that can help a lot.
I understand as well that when you bring it into the asset management space, that one of the problems with a lot of the data is that it doesn't deal well with time series. Have you found a solution to this?
The data is less about time series. And, I think the challenge is that the existing folks in asset managers who are most comfortable in dealing with data tend to come from a quant background. And everyone is comfortable with their own starting point. And so they want to start there. And so they ask questions about time series. They ask questions about 10 years of history and so on and so forth. And in many cases with these data sets, those are not the right questions. In fact, I find that the way that fundamental investors think about their problems is the right set of problems, but they don't have the math and computer science methods to think about those problems. And so it really is in the middle of the two. And if I could just take a second, I'll tell you a quick anecdote related to that. And that is that fundamental investors, they want to get more involved in quantitative processes. So what they'll do is hire an analyst, have him scrape the web, find me the magic number, and then I'll manually put it in my spreadsheet. And the quant investors, they want to get more involved in fundamentals, but they want to have history and they want to stay true to their process. So I have a friend, Richard Sloan. He teaches a 2-semester graduate class at USC. He writes textbooks on valuation. He has quants calling him up and asking him, okay, now I have you on the phone. What ratio should I use? And he wants to tell them, if I could reduce it to a single ratio, why do I have to teach a 2-semester graduate class? And so essentially, everyone wants to bring the problem into their own comfort zone, as opposed to thinking about this as a brand new problem which has its own features. And so I think that signal processing and lots of history are less important, sort of absolute measures, but less important than sort of a relative measure of which company is gaining market share and gaining a total addressable market in terms of their customer base, and which ones are losing it. And that's information that doesn't require lots of time series and lots of history. It's more what I would call a spatial ensemble than a temporal ensemble.
Is that the right way to think about these things, where you use traditional techniques but then enhance them with data science?
It is a combination of the two areas, but I think that there are lots of ways of thinking about how to combine the two areas. We have the opportunity at Neuberger to actually look at what I think is the strongest way to do it, and that is start with the fundamental model, which is a financial model of the business, and elaborate it in more detail and updated it automatically at scale with computers. And so you're really starting with a fundamental model. I mean, the fact that it's quantitative, it just means you're using computers. And it's much less to do with stochastic calculus or some of the signal processing methods that sort of have been common in education systems around quant.
So what are some of the promises that the more artificial intelligence, machine learning type strategies hold? Because I think one of the issues there is as well that some of the strategies have some promise, but then to bring it back into a fiduciary environment where you have to explain what it's doing and explain every step along the way, that can sometimes be a bit challenging.
Well, so I have a story related to that too. I was giving a talk on use of data in investing at one of the universities in New York, and after the talk, the dean at the university asked me a question. He said, how will businesses ever trust these machine learning methods? They're black boxes. We don't know how they learn. We don't know how they represent information. We don't know how they make decisions. And I said to him, well, here we are at a university, and we don't know, and where we train these students, and we don't know how they learn. We don't know how they make decisions. We don't know how they represent information. So how will businesses ever hire them? And the answer is that they'll hire them because they'll give them a small task first, and then once they perform well at a small task, they'll give them a bigger task. And the exact same thing will happen with these types of models that and we'll gradually understand them. We'll certainly understand them before we'll understand the people.
So it's not so much the problem with machine learning, but with machine teaching.
The problem is that, again, it's a challenge to think about how to use new methods that we haven't used in the past. But the way we always use new methods is we only trust so far until we actually have more experience with them.
Yeah. So you've been in this field a long time. Can you tell me some of the changes that you've seen over the year? There's obviously a lot more data to play with, but have the techniques changed as well?
Yeah, I think the techniques certainly have changed. I mean, I think that some of the first methods of using data were really using data in itself directly. So as I like to say, you take the data, you remove the outliers, you normalize it, then you shred it and put it in the soup. That's sort of a quant method. I think now you might need more data sources in order to understand it. And what we're doing is we're inferring things like demographics and psychographics from the data. So if I look at credit card transactions, I can infer male, female. I can infer a millennial, baby boomer. I can know income level and so on and so forth. And then I can look at who are in the customer base of what types of individuals are in the customer base. And is a company expanding its customer base, or is it just getting more loyalty spend from the same customer base? Or is it losing some of that customer base to other competitors? And then you also bring in other data sources in order to detect where you might have a bias, because all data is biased. And removing bias is the best thing, but detecting bias is the second best thing, so you can know something about conviction. So I certainly think that the field is going to progress, but I also think that there's an enormous amount of inefficiency in the market, and so there's a long path ahead.
So what are some of the data sets that you're most excited about today?
Yeah, well, interestingly, one of the earliest data sets that people are using in this space is credit card transactions. If the weather's nice, people go shopping. You can get cell phone location and know they took their phone shopping. But if you have credit card transactions, you know what they spent. So I like to have transaction level data that's as close to the coal face as possible. The more detail, the better. And also as granular as possible. I like to tell vendors, I don't want raw data. I want rare data, slightly cooked.
Right. Okay. So is that still relating then to credit card information, or do you overlay it with new sets? Or?
Well, so the credit card information, so it'll contain things about consumer, but people say, well, isn't that just about consumer? Well, I think that the consumer affects all sectors of the market. You have consumer fintech, consumer banking, consumer healthcare. And so the consumer is a driver of lots of the economy and in terms of supply chain and everything else. I mean, one of the interesting things from credit card that may surprise people is you can use credit card data to read out oil production.
Right.
How do you do that? Well, it turns out that between 10 and 50,000 people in the U.S. lease their land for fracking. There are a handful of trusts who make royalty deposits into their bank accounts, and the royalty deposit is proportional to the oil extracted. So you find a few hundred of those in your credit card data, you regress it against U.S. oil production, and you have a regional read on U.S. oil production in real time.
So with some of these signals or indicators that you find within the data, I suppose some of the more cynical investors say, well, it's all very nice, but within a couple of months, it's all arbitraged away. How do you deal with signal decay?
Well, so there are lots of cynical investors related to this, and I like the perspective I like in terms of describing this and thinking about this is comes back to the joke version of the efficient market hypothesis, which Eugene Fama won the Nobel Prize for. So the joke version goes like this. Professor Fama is walking down the road with another economist. The other economist says to him, look, Professor Fama, there's $50 on the road. Professor Fama says it must be counterfeit or someone else would have picked it up. So when I talk about data for investing, people say it must be impossible or 2 Sigma and Citadel would have picked it up. And so essentially there's a strong belief that, and it's sort of people have been working very, very hard in this industry to try to make money, and they really are resistant to someone saying you've been walking past a pile of gold as you slaved away to try to use your method, and there's some other methods that actually work better. And, that's a little bit of a soul-destroying thing to tell someone. And so I think that there's going to be a lot of reluctance to move into the space. I was speaking a couple of years ago with a fellow named Neil Chris. He's one of the early statistical arbitrage quants. He ran the Cubist function for Steve Cohen. He built his own firm called Hutch and Hill. He's described in the book called The Quants from the early chapters. He said he can't count the people who said to him they wish they were in statistical arbitrage 20, 30 years ago because it was like picking up money off the street. It was very easy to construct a strategy that made money. So the reason why they weren't in statistical arbitrage is because doing signal processing with PhDs in physics wasn't the way they thought about investing. He said 10, 20 years from now, people are going to look back at this period of time and say, gee, I wish I was in data-driven investing in the early days. Yeah. But the reason why they won't be is because it's very different from the way they think about investing. And so, it's, I think it's useful, and I like public speaking related to explaining how this method works. But I certainly think that many, many people will. There's a quote I love, which is, I believe it was Churchill, but I might be wrong. He said, a man will occasionally stumble upon the truth, but usually he picks himself up and continues on.
Yes, indeed. So when we look at where we are today, you said that it's a very different way of thinking about investing, but probably people are a little bit more familiar with it today than they were probably 20 years ago. To what degree do you think that going forward this will become more of an arms race in the sense that the person with the largest budget and computers will be able to extract the most value from this type of data?
Yeah, so just to quickly address the first part of that, I do think people are very aware of the idea of using data for investing, but one of the things that they aren't thinking about sufficiently is the technology changes that are required. Most bricks and mortar businesses, and I include most asset managers in this category, they treat technology, they only want to stay, 10 years behind in technology. And so the technology stack they need really to process this data. And not only that, they're not used to engaging technologists as creative participants in the business. They're used to engaging them as people who do work orders. And so it's that change in their engagement which is going to be important. But to get to the arms race question, one of the things that we've managed to do with some experience is to acquire the same data for much, much less money. So, for example, I pay 1/20th about for the credit card data compared to what I paid for it at a hedge fund. The story is actually very straightforward. And the story is that when I approached the vendor that sells the data, I said to them, look, I want to pay essentially 1/20th what I paid when I was at the hedge fund. And they laughed at me. And I said, why would we ever do that? I said, well, you can take the data and delay it by a month. Now go to the hedge funds that trade on events and ask them how much they'll pay for it if it's delayed by a month. The answer is zero, because they want to trade on events and we care about long-term capital gains. So you're not selling to any asset managers at all. And they don't, and because they don't want to compete with these hedge funds for price. But they don't mind if the data is delayed. So I help you build an entire new channel for selling your product. Before we have any more conversation, I get it for my price. So I was at an event last year with our president of our firm, and he was asked by one of our investors, how much does this data cost? And he said, well, this data is really expensive. It costs hundreds of thousands of dollars. I said, no, this data costs millions of dollars. We pay hundreds of thousands.
That's a very good way of describing it. So I want to go a little bit back to earlier in the conversation. We spoke about you have a background in neuroscience as well.
Mm-hmm.
And recently I was talking to one of the neuroscientists at one of the universities here in Australia. And he had this interesting concept around the type of problems that people try to solve. And he basically illustrated it in a way with a jigsaw puzzle and with a jar of different colored lollies. And he said, a lot of the problems we try to solve in investment is the lolly jar, where it's a game of probability. The more samples you're allowed to take, the more accurate your solution will be. But there's another type of problem, and that is all the information is already there. You have the jigsaw. It's about how you put it together that is going to give you the right solution. And he says, often in investing, the information is there, but how you put it together is whether you're going to extract value or not. So many people are solving the wrong problem. What is your opinion on that?
I think it's right. I absolutely think the information is out there, and I think that people have been not paying attention to it because it doesn't fit in the way they think about processes. So I think it's creatively thinking about how to use the information that's out there, and I find it sometimes quite surprising that something as driven by straightforward metrics of performance, like investing, that it isn't actually making those creative steps to think about how to use information better than it has in the past. And I come only to the investing world 5 years ago, but and I have to say from the outside, I expected it to be much more efficient at that puzzle solving problem than when I arrived and I found it to be.
So there's lots of room for improvement?
Oh, there's an enormous amount of room for improvement. I mean, when you watch the reactions of markets to information and you sort of shake your head and think, well, gee, why is the market not as more informed than it seems to be?
Yeah. Now, you spoke about the hedge fund where you had to pay a lot more because it's more about the events rather than a long-term time frame. Can you tell me a little bit more about how data science is applied in these different environments? So you have the hedge fund, you also worked for a sovereign wealth fund, and
yes.
now a fund manager. How do you apply it differently?
Yeah, so I think there are 3 primary time domains that are distinct where people think about using data for investing. And I've been involved in 2 of those time domains, so let's just lay out all 3 of them. So the first time domain is a time domain where you're using information like social media, news, and sentiment. And so if I know before you do, because I'm using natural language processing in a computer and consuming lots of news sources, that Panasonic is going to not do this next round of investing in the Gigafactory, then Tesla stock is certainly going to go down today. And so that's a front-running race. And so it's sort of a race towards high-frequency trading in the shortest time domain. That use of data I've not been particularly involved in. The second time domain is around quarterly earnings. Now, quarterly earnings are fascinating because when companies tell you how they're doing, there are all these so-called earnings surprises. And the mere fact that there are earnings surprises is the clearest indication that the market's not efficient. Because if we're surprised, it clearly isn't priced in.
Yes.
But what the CEO and CFO will tell you is something about top-line revenue, something about earnings per share, something about future guidance. All of those things are discoverable in data, and the data can actually compete quite well with discretionary folks at guessing that information. With discretionary folks are sometimes using social networking and spreadsheets and other sources. I describe some of them as listening to the chirping birds, and they learn over time that when this bird chirps that way, they have to do something.
Yeah.
So that's the second time domain. The third time domain, again, because the CEO and CFO don't tell you everything, the third time domain is knowing more about the business than everyone else does. And that allows you, almost like in a private equity way, to buy the next Google before everyone else can see them. And that requires lots of depth of data, and it's a longer term investing. Sometimes you might have to wait for a year to get paid because you know something and you have to wait till the market discovers it. And that's the time domain that we're really working in at Neuberger, where we're understanding businesses in much more detail than, and it's sometimes when we meet in corporate access meetings and we tell things to the CEO of public companies, they're surprised.
I find it interesting because the type of organization and your objective matter in how you use data and how you use your algorithmic trading. And it also made me think that a lot of people seem to think that this is just unbiased material and you will get the same outcome no matter how you use it. But that's obviously not true. It also makes me then think, how do you deal with some of the biases that might be introduced by the way how you interact with the data? And I've used this example a couple of times, but some of the progress that has been made in natural language processing is quite interesting. And to me as a journalist, it's interesting because I thought it's going to save me a lot of time in transcribing all my interviews. I just put it into this software and it all comes out nicely. Well, your voice will come out nicely because you have a very clear US accent. My voice is completely ununderstandable by a computer. But I can imagine that will come back in different ways in how you use the data as well. How do you deal with that?
Well, I mean, I think the most important thing when you're using a data set, to start at the beginning of your comment, is to detect bias. And as Peter Norvig, one of the senior engineering leaders at Google who built Google Translate, he'll tell you on YouTube videos that the more data is generally better. I mean, it increases the accuracy of your processes. But if you include any bad translations, you can't overcome. And so it's worth throwing away some of the data if you know there's a risk of it being erroneous, and even if you lose some good data along the way. And I think that's a really important thing, and most people who are processing data aren't doing that. The other thing I'll say is that to your point around understanding natural language processing is that in some data sets, you have more data from each individual. So for example, if I'm looking at credit card transaction data and there's 3 or 4 banks in it, then even though I have billions of transactions, there really are only 3 speakers. Each of those banks has a consistent way of speaking. Whereas if I look at bills of lading, customs documents for shipping, each one is written by a different person, and I might only have one piece of evidence from that one person. And that's a much, much harder natural language processing problem because I have one shred of evidence of the way one person speaks, and I have to, or writes, and I have to figure that out to understand what the contents are. And so we are very focused in our processing of not just how many data points you have, but how many consistent data points from a single source you have to try to resolve what that source is telling you.
Yeah, and that comes back to structuring the data and cleaning the data. To what degree do you think that part of data science is well understood?
Well, I think it's actually the core of, so the way I think about our process is there are several different roles and sort of in a pipeline. The first role is data sourcing, and that requires some understanding of what kind of data might be useful, an ability to ask the right intellectual questions, and almost like a SWAT team type efficiency at actually quickly evaluating lots of different data sets. The next stage in that pipeline is the one you're talking about, which is natural language processing. How do you actually, once you have this data most efficiently and with the least bias actually do the labeling of this data. And again, sometimes these first two steps will be outsourced by asset managers. The third step is model building. So now that I have extracted information, so let me just pick on the labeling for a moment. So if I have a transaction that says PayPal through Expedia for United Airlines, there are 3 vendors involved. But if it says Starbucks at the Hilton, Hilton gets rent. Right. and so there's lots and lots of complexity about how you process those transactions, as well as misspellings and funny brands and so on and so forth. And so that's really important. And sometimes when you're hiring that person, they don't need to know as much about finance as they do about how to process data. The third step, which is trying to use those pieces of a puzzle, to use your analogy, to then figure out how this business is doing. And that requires someone who has an interest in business, who is also a data scientist and working at scale. And then once you've done that, there's the next stage in the process is screening. So I have all this information about a bunch of different companies, and how do I identify opportunities? And all of this sits on top of what I call data engineering, which is another set of people who love tools and who love efficiency and who love thinking about how to do these things at scale. Interesting thing, you look at sports and you say, well, there's a forward, there's a guard. Basically there are about 5 different roles, all called data science, that's required to build a team that does this effectively.
To what degree is data science then about maths, and how much is it about creativity and being able to anticipate the problems that might come up? You mentioned that example of misspellings and common misspellings, and you sort of have to think a couple of steps ahead and come up with multiple scenarios in your head of what might happen there. To what degree is creativity a part of that?
Well, I think it's absolutely huge, and I think it's what appeals to me. I mean, I went from Intel to academia because I wanted to work on more open problems, and I went from academia to industry because I want to work both on big open problems, also which have high impact. And so I think the fact that these problems are so open is really important. I think to provide some context and to look at some of what some of the firms are doing, I don't want to necessarily name them, but some firms at one end of the spectrum, the way they find gold is you can think of as strip mining. Everyone works in lockstep, and they just remove the next layer. They produce the next processor. Everyone's doing the same thing, and someone actually has the insight of exactly what needs to be done. But there's almost no creativity or less creativity, because everyone's simply just following through with what the overall organization's goal is. At the other end of the spectrum, you have like the pharmaceutical industry, where you have lots of individual scientists, but each one is a prospector. Each one's thinking about their own ideas about how to find a new drug. If one of them finds a drug, everyone wins. And in that spectrum of strip mining to prospecting, I believe that if you have a big open problem, like how do you do this in finance, it's much more in prospecting. In fact, I used to say to people, the worst thing I can do is to tell everyone to dig in the same place. Yes. And so I think that when you're looking at how firms do this, I've been a manager for 40 years of people, and my number one rule about management is never tell people what to do. Right. And so you want to actually inspire people with what the needs to be done and the metrics for measuring that, and you want to have as diverse a set of people as possible to come up with lots of crazy ideas for how to do it, and that's what makes it fun, and that's what makes it successful.
Yeah. So what are some of the areas that you think we'll see most innovation coming out of?
Well, I think one of the challenging but exciting things that's happening is that all of this application of these methods into finance is happening during a period of time, call it the singularity, where advances in machine learning in both processing of images, processing of text are advancing at a phenomenal rate. So one of the challenges that we have, and again, it's an exciting challenge, is to keep track of what's happening in academia, and so that we can understand the best set of methods. At the same time, lots of new tools are being developed in the cloud environment. I was just at a conference before coming to Australia in San Francisco, where I was speaking at the in the development of new cloud tools, and so I think that's going to change. The landscape that we do the work in is changing at a phenomenal rate. I also like hiring people straight out of college, because a lot of times they come with some experience with some of the latest methodologies. And so I think it's, again, that's one of the ways that it's very, very different from the quant processes, as certainly from the discretionary investors processes, is that these completely different stack of tools that, again, people have been thinking about their technology folks as someone who fixes their fixes their email, put a phone jack here, and writes this piece of code, and it's going to be a completely different world.
Now, another part for investing is also the incorporation of ESG and governance frameworks. Is it possible to build ethical considerations that or values that an organization might have into these algorithmic strategies, and do you think that should be done?
Oh, absolutely, yeah. And I think that there's lots of academic research that shows that you actually get paid for doing the right thing. In some cases, with some of the businesses that have actually had governance or other issues, it may take you a while. The stock might, the performance might look very good, but the rot comes through, and so we and Neuberger was the first firm asset manager in the world to actually have socially responsible investing, and it's partially because we started with wealthy New Yorkers and direct wealth management, and there are a bunch of people who want to make money but want to feel not feel guilty about it, and so we were for the first in social responsible investing, and we have now a big ESG team, and we share staff with them in order to help them process very large data sets. And we also have just started collaborating with the UN. They have lots of interesting data that we can help them process in order to understand, get better data sets on social impact, on environmental impact, on governance. And I think there are some vendors who've started in the space to try to, again, package and sell the data. But I think the real opportunity in understanding how businesses work is very much the same. If you're understanding how a business works from the point of view of how good they are to their customers and how much they're expanding their client base, then you're also understanding how the customer, whether they're cutting corners and doing things untoward that are going to challenge the business in the future.
So it's not simply a matter of building some negative screens into an algorithm?
I don't think so. I think it's really a matter of, I think largely due to inexpensive electronics, there's information about every aspect of businesses that is out there in the world. And what the data are doing, just to your puzzle analogy, is putting together this picture puzzle to tell you everything about a company. And where everything about a company are the reasons where success is coming from, as well as any challenges in the way that they're accomplishing that. So I think we're just going to understand businesses better in all aspects, and that's going to help us make much better decisions about which companies we want to own part of.
Yeah. If we look a little bit into the future, to what degree do you think that innovation or development of this space might be inhibited by the understanding of the stakeholders involved? So I'm thinking, for instance, some of the organizations are made up of boards that are not financial specialists, and I think some of the investment strategies can be sometimes hard to understand, especially if you go more into the alternative and derivative space. Then you put on top of this layer of data science that might be a whole another complexity to them as well. How important do you think it is to get stakeholder buy-in when you're developing these strategies?
Oh, I think the nice thing about these strategies, I'll say, to look at it from the other direction, is that people automatically understand it better. In fact, I've heard from many people in the industry that if you try to convince a CIO on some quant strategy, the CIO might understand it, but then they also have to explain it to their investment board. And because of the challenge in sort of communicating that corresponds to a larger margin of safety between your guaranteed returns and the management fee. And so, whereas if I can explain to someone how a higher resolution microscope and better understanding of the business is going to lead to better business decisions, people get it immediately, and there's less of a hurdle. So I think some of these quant methods of looking at signal processing and so on had this burden of lots of math and sort of this magic in the math that you couldn't quite get. And we use math too, but we use math as part of our microscope. And at the end of the day, when you have an insight, you have the insight. And the math is just a mechanism to get there. The math isn't the insight itself. And I think that provides an advantage in terms of people understanding it and stakeholder buy-in, because they just have an easier time understanding what you're talking about.
So to a degree, it's easier to bring the concepts behind the strategy across than it is when you do a very specific trading strategy.
That's right. In fact, when people ask you a question, why do you believe this? If you end up with a page of math, they're going to be stuck. But the interesting, when I interview people, one of the questions I ask them in an interview is, tell me about something that you learned that was different from what you thought when you started. Because that's the nature of science. And that's why I think it's chief data scientist as opposed to data engineer. Because in science, you often don't know you have this circuitous path to discover something. Post hoc, it makes a ton of sense. Once you have the epiphany, it's absolutely clear. You don't know why you didn't think about it in the first place. And so it's those types of insights that you're looking for in people you want to hire, because that's what the data science is about. And so once you have the insight, once you've found the path, everyone completely gets it.
So what was one of the more interesting answers to that question that you've received in these interviews?
I let them take any field that they've been working in, like from what they were doing in physics or otherwise. But one of the examples from I would say is that someone was actually looking at for a supermarket. The supermarket wanted to print personalized coupons, to come back. The supermarket had a top-down belief that the way to partition their customers was by life stage. Single married young kids, all the way to, retired, and lifestyle, which is a proxy for wealth. And that's, let me just figure out what they're buying and figure out what coupon to. But this particular person discovered that the better partitioning was where they'd immigrated from and how long they'd been in the country. Right. And that was actually a better predictor of the things they were buying than the parameters you're starting with. And so the trick is that with top-down classifications, and this is also relevant in this whole idea of how you evaluate people. If you start with a top-down classification, you're essentially starting with a pre-constructed framework. And if you're starting with the data, you really don't have a preconcept figure out what the data tells you. And and I think that's what's exciting to me about this data-driven process is finding methods to start with. In fact, people are talking about build a model of a company one customer at a time. Yeah. So that if I can figure out how each customer relationship looks, and I can sum it up and look like the health of the company. And really, I think it's this approach of starting with the data and then coming up with what does it tell you, as opposed to seeing if it validates some top-down hypothesis that you have from what the framework is telling you.
Yeah. And if we do a little bit of crystal ball gazing, next 5 years, where do you think this field will develop? Where are the most interesting parts?
Yeah, so again, I think that, I've been teaching at every place I've been, and I just finished the first class at Neuberger, teaching portfolio managers how to code. And there's been a debate about, are quants going to get interested in business? Most of them don't read the Wall Street Journal. Or are fundamental investors going to learn to program? And I actually think the fundamental investors are really driven to actually have unique insight. And my money's on the fundamental investors learning to program. They already write very complicated macros, So I think that what's going to happen is that we're going to end up with a set of asset managers who are using the right methods, who are going to be once again better than indices and better than other asset managers, and they'll be doing significantly better. Another thing is I think that we're going to have more and more data scientists. We embed data scientists also in investing teams, and in some cases the team then steals the person, and you hire some more data scientists. Then people ask me, how many data scientists do we need when we're done? And I use a quote from Alexander Graham Bell. He was asked, how many phones does the world need? His answer was, each town needs at least one. So if I tell you everyone's going to be a data scientist, you might not believe me. But if I tell you each town needs one, you'll believe me.
It's very interesting because I had a conversation with one of the people in this field, and he still felt that the first response was, okay, we've got this new strategy. We think this is going to work. Can you please automate it? And his response was, if it's just the automation piece, you should know how to code. Mm-hmm. Do you think that we will head there where every portfolio manager needs to be able to code?
Yeah, I've been speaking to lots of universities, and they don't really have the right degree program. I think the people who will be golden in the future are people who can think about business-driven valuation of companies and can code and do math. And there's no degree program that's generating them, much like there wasn't a quant degree program before. And I think that's the degree program that will come about. In fact, I tell people who are students, I say, don't graduate until you can code. because it doesn't matter what field you're going into. Coding is one of the most powerful things that to future-proof whatever your career is going to be. So I absolutely do think that, and I think that there are going to be lots of jobs that are going to be automated away. I mean, there was an interesting statistic I was reading the other day that most people think that 90% of the jobs will be done by robots or automation, but also the vast majority don't think it's their job. So it'll be interesting to see what happens in the next set of years. But again, the best way to future-proof a career is to actually get involved in coding early.
Mind you, I think if you ask most people if they thought they were going to be doing what they're doing right now 20 years ago, then none of them would have predicted that either. So I think at the same time, jobs will change and there will still be jobs around. They will be just very different. Yeah,
and the other thing, I mean, I love this quote about because people often think about the future as if it's like a wave front that moves across, and the quote I love is, "The future is here already. It's just not uniformly distributed."
Yes, that's right. Well, Michael, thank you very much for this interview. It was a pleasure talking to you.
It was great speaking with you too. Thank you very much.
Thank you. Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.